Well, market couldn't really hold on to their gap up gains in the first half. There is some amount of nervousness which is setting in. Let's talk about the, what are the factors at play in the market with Vinod Karki, who's joining us. Vinod, the market seemed to have come under a bear grip in the last couple of trading sessions. What, to your mind, are the factors which, due to which, market is looking very subdued and in a corrective phase? Because inflation clearly seemed to be peaking out. That was the issue on margins. What else do you think is, plaguing the market right now?
Hi, Ajay. So I think if you look at broadly, it's the outperformance of India. If you look at from the second half of this year, when index, if you remember, was close to 16,000, So from there, it's been a spectacular run in 6 months. So that's the thing. I think then the valuations went almost to 20 times, So that's one of the reason I think, because if you see the earnings, they've been pretty decent so far, what's been reported. And business updates have been also good. The high frequency data, if I look at GST, the PMI services in our manufacturing, everything looks reasonably okay. I think it is the some bit of optimism, which extended a bit. That's resulting in India a little bit of weakness there. But overall, I think the big move for 23, if you look at the indicators, the biggest takeaway from me is that we are entering in 2022, it's all about quantitative tightening. I think 23 is about end of quantitative tightening, if not the start of QE. So that's the big one for me. And the valuations obviously will get support if the Fed ends the quantitative tightening cycle. So that's the key. Earnings, I think, will continue to be reasonably fine, and especially on the margin side. And the investment side and the credit side of the economy look quite robust to me. The consumption is split between discretionary consumption doing well, but they're expensive, and the other type, the mass scale staples and all, there is weakness overall. So that's how it is. Investment credit cycle looks pretty good. Stocks related to real estate cycle look good. The overall investment cycle looks good to me. So yeah.
Vinod, how did you analyze HDFC Bank's earnings? Because internals actually, not the headline earnings, especially deposit growth. And I want to understand, what is your take on those franchises in the banking sector or lenders which have very high quality deposit growth and who are able to garner a lot of deposits? Because that's the fuel for banks. Going forward, the names which will have good deposit growth and good amount in the deposit only will be able to benefit from this 18% credit growth, isn't it? What names come to your mind in healthy credit growth kind of category?
Yeah, from a capital perspective, you're right. But you have to remember that a lot of these banks, especially the PSU banks and all, they had been holding government securities in excess of what they want to hold. So immediately there won't be any dearth of capital so far. But as we enter a strong credit cycle, obviously deposit growth will have to keep pace. Otherwise, you'll have problems and margins will be under pressure. And it's very obvious that some of the banks who have great deposit franchise will be at a benefit. Like HDFC and others, basically. But for now, I don't think the credit cycle is just picked up. So don't need to worry too much about the deposits not being as high as credit growth. It will be an issue later on, but let the credit cycle pick up and let's see how it goes along.
Right. What about the PSU end of the lenders? We just did an exclusive story today where Union Bank is raising almost 3,500 crore via QIP. And we've seen that some of these quality PSUs have now become very investment grade. And do you think this side of the basket also is witnessing good appetite from institutional investors, and hence capital raising for many of these names will not be an issue?
Yeah. So PSU banks, I mean, the top pick in the financial space has been SBI for us for quite some time now. So I mean, selectively they are. We would prefer them. You know, so they are in a good space. I mean, there's a valuation comfort. The biggest thing is even after this outperformance that we have seen, it's not as if these companies are obscenely expensive because the battering that they've got over the last decade or so has been a massive one. Where their NPA cycle went up and credit growth was not there. I mean, so the entire they had a massive, what you should say, down cycle, and they're just emerging. I think this is the first year of emergence from this cycle. So I think even statistically they will be, in a phase where for the initial 1 or 2 years, I don't think there should be any issue around these companies, especially when the NPA cycle is bottomed out and the credit cycle is picking up, and they have a decent retail, I mean, deposit franchise overall.
Vinod, talk to us about some of the feedback you're gathering from your institutional investors and your latest conversations with them. Is budget an issue? Is continuation of reforms, especially the capex push, be it via railways as a vehicle, or in general PSUs are in capex mode? All these are coming up. Just want to take a feedback on the areas institutions are actually talking to you about.
So I think broadly everyone is kind of agreeing on the overall investment cycle and the investment side of the economy doing well. What worries investors, I think broadly, is that the valuations are expensive compared to other emerging markets. That has been a biggest worry. I mean, that valuations are pretty high, and you're not getting any bargain prices. That's the biggest this thing. I don't think anyone is too worried right now on India's fundamentals, be it the investment or credit cycle. I mean, there are worries on consumption a bit because there has been a dichotomy in terms of how consumption patterns have been showing up. There is one area which has, I mean, the discretionary consumption, be it houses or luxury cars and travel and other things, more of discretionary has been pretty robust actually. Whereas mass consumption stocks, I mean, where there has been weakness over there. So I think it's a split in consumption, but and our exports has been an issue. So I think people do worry about it. So if the major economies in the world, if they are going to get into some kind of a recession, obviously exports will be a drag, but it is, I think, getting counterbalanced by some of these new areas where India has been beginning to build a manufacturing base for exports. So which was not there earlier, but like to like basis, some of these export areas will be weaker. So I think that is the thing. Not too much worry that we earlier used to have on government revenues and fiscal deficit, because that's going to come down. So or from a macro perspective, it's reasonably good on the government revenue side and their ability to spend on capex and infra. That's not an issue which used to be there earlier. Oil used to be a major issue, but now it's around 80, so I think it's fine. So net, it's the valuation angle which keeps investors a little less excited about India broadly.
All right, thanks very much for joining us on the show today, Vinod. That was Vinod Karki, Chief Strategist